Coming up on Market to Market, Senate Republicans make good on their promise to advance the Keystone XL pipeline. And renewable fuel supporters blast Obama administration plans to cut the amount of ethanol in U.S. gas tanks. Those stories and market analysis with Sue Martin next.
Funding for Market to Market is provided by Renewable Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Renewable Mutual, a policy of working together. Information on finding an agent near you is available at GrinnellMutual.com. This is the Friday, January 30 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The U.S. economy slowed in the final 3 months of 2014, but a burst in consumer spending raised prospects that growth will strengthen this year. The economy, as measured by gross domestic product, grew at a 2.6% annual rate in the October through December period, virtually half the pace of expansion in the previous quarter. Consumer spending, which accounts for about 70% of economic activity, increased by 4.3% in its best performance in 8 years. But government spending, U.S. trade, and business investment in equipment all declined in the final 3 months of 2014. Economists blame part of the decline in business spending on cutbacks in oil drilling as producers adjust to plunging energy prices. And with record supplies of crude oil as a backdrop, Senate Republicans advanced a key component of their agenda.
To vote or change their vote? Hearing none, the ayes are 62, the nays are 36. Senate Bill 1, as amended, is passed.
The Keystone XL oil pipeline cleared another legislative hurdle this week with passage in the U.S. Senate. The Senate's version passed on a vote of 62 to 36. 9 Democrats broke ranks to vote with every Republican senator in favor of the bill. The controversial 1,200-mile pipeline would carry crude primarily from Canada's oil sands to Gulf Coast refineries. Supporters of the pipeline contend up to 42,000 jobs would be created, while causing little to no impact on the environment. The State Department estimates only 35 of those jobs would be permanent. Democrats frame the bill as a gift to a foreign oil company offering little benefit to the American people.
This is the only time in the history of the Senate that we have given such a big hug and kiss to a private company, any private company, American or foreign.
For energy security, for good trade relationships with our neighbor in Canada, for all the right reasons. It was important that we pass this legislation in front of us today.
Environmental groups claim Keystone would tap a dirty source of energy that would exacerbate global warming. And that fact is not lost on President Obama, who has repeatedly delayed a decision on Keystone since it was first proposed in 2008. The bill now heads to a conference committee before most likely advancing to Obama's desk, where the president has threatened a veto.
The International Monetary Fund, or IMF, predicted last week that the U.S. economy will grow this year by 3.6%. If realized, that would be the fastest rate of expansion in more than a decade. But that is definitely not the case everywhere in the world. Growth in China is slowing, and Europe also is battling renewed economic weakness. And the IMF cautioned that slowdowns in most major economies will trump lower oil prices. But that may be hard for U.S. motorists to believe. Crude oil fell to a 6-year low Thursday, and the American Automobile Association reported Friday that the national average price of regular gasoline was $2.05 per gallon, down more than $1.20 from the same day in 2014. Ethanol producers tout their product's ability to lower prices at the pump, but they too face an uncertain future. And this week they circled the wagons at the Iowa Renewable Fuel Summit. Paul Yeager explains.
2 years. We came right up to the blend wall. We were about to crack through with the help of the RFS, which is what the law envisioned.
Politicians and biofuel industry leaders gathered in Iowa this week to discuss the outlook for renewable fuels. Those in attendance wasted little time before jumping on the high-octane topic of the Renewable Fuel Standard, more commonly known as the RFS.
It's an odd thing that it takes a mandate, an RFS, a requirement to let the market work.
The RFS was originally implemented in 2005. It mandated that all gasoline must contain a minimum amount of renewable fuels. In the beginning, that amount was 7.5 billion gallons annually. 2 years later, biodiesel was included and the level was increased to 9 billion gallons. Other congressional changes established the ambitious goal of 36 billion gallons of biofuels being blended into gasoline by 2022. But in 2013, the Environmental Protection Agency, which oversees the RFS, called for cutting the mandate by 6% to 13 billion gallons due to a decline in gasoline demand. The reduction wasn't implemented in 2014, leaving the industry without a clear indication of how much ethanol would be included in America's fuel supply.
Until they make an announcement, leaves that uncertain. The idea is that we won't likely see a lot of investment in the ethanol industry. Once they make that ruling, especially looking at 2015, that will determine what's the impetus for some investment.
Renewable fuels proponents cried foul over the delay, saying the RFS is a congressional mandate that boosted the biofuels' ability in the open market.
When it's lower priced, it adds qualities that gasoline absolutely needs, and we should have been growing. So what wasn't allowing that? It was access to market. You all know it.
Those lamenting bureaucratic delays also blamed big oil for denying ethanol what they believe is its rightful place at the pump.
Is there concern in the past that the oil industry is not so friendly with competition to their product? I think there's a pretty long track record of the oil industry not being particularly friendly to products that are competitive to them, that may even be superior to them.
I sat in all these meetings where we were trying to go to E15, and guess what? The oil industry pushed and pushed and pushed back because they didn't want it to happen, and now they claim there's a blend wall. Well, hell yes, there's a blend wall. They helped create it.
The blend wall refers to the infrastructure problem for blending ethanol. Right now, all gasoline is blended with 10% ethanol. The biofuels industry has been trying for years to move that number to 15% ethanol. And in 2012, the EPA approved E15 for all vehicles manufactured after 2001. But the oil industry claims most cars on the road are not properly equipped for E15. And it says the consumer could be left paying a hefty price if they end up at the corner gas station spending more money on repairs than on filling the tank. A spokesman for the American Petroleum Institute, in response to this week's rally, told Market to Market, "This issue is more about consumers than it is about the petroleum industry. If consumers are forced to use E15, we can expect broken down cars and high repair bills. This will occur because E15 can damage engines and cause breakdowns. According to the Coordinating Research Council, this could even occur in vehicles approved by the EPA for E15. Auto manufacturers have said they will not honor warranties when E15 causes damage. Furthermore, since ethanol contains 33% less energy than gasoline, E15 lowers mileage." Consumer groups also have warned that EPA should suspend sales of E15, believing that many cars are incompatible and consumers don't know the potential dangers of using the fuel.
When you look at ethanol, that's always been its one big bugaboo in the marketplace, is that it is a fuel type that it has some different characteristics than gasoline, and so it can create some problems in especially older vehicles. It takes time. When you're talking about a vehicle fleet of over 240 million vehicles across the country, and usually the vehicle flip is about 7-8 years, it takes a lot of time to move a technology forward.
Ethanol proponents are quick to note their product's ability to lower prices at the pump. But some supporters claim the renewable fuel plays a vital role in achieving energy independence and maintaining national security. For Market to Market, I'm Paul Yeager.
Next, the market-to-market report.
Grain futures prices declined again this week despite a weaker dollar. For the week, March wheat lost 27 cents, while the nearby corn contract moved 17 cents lower. Soybeans also were pressured as the March contract gave up 12 cents. Nearby meal prices followed suit with a loss of $1.60 per ton. In the softs, cotton broke back through the $60 barrier as the May contract advanced by $1.82 per hundredweight. Over in the dairy parlor, both nearby and deferred Class 3 milk contracts gained 99 cents, and the bulls returned to the livestock pits as the April cattle contract gained $3.47. Nearby feeders advanced by $3.38, and the April lean hog contract moved $1.60 higher. In the currency market, the euro strengthened for the first time in 8 weeks, gaining nearly 5 basis points against the U.S. dollar. Crude oil gushed 8% higher Friday to post a weekly gain of $2.65 per barrel. COMEX gold declined by more than $10 per ounce, and the Goldman Sachs Commodity Index advanced by nearly 8 points to settle at 387.50. Here now to lend us her insight on these and other trends is one of our regular market analysts, Sue Martin. Sue, welcome back.
Thank you, Mike.
Let's jump right in and let's talk about this wheat market. We've seen consistent selling in that market, and we're getting close to $5. Are we just not gaining traction on the export side, or what's happening?
Well, I think we've had some export business. In fact, this has been an active week as far as talk around and rhetoric around the world in various places. Argentina has said that they will not extend export permits to their exporters if they don't pay the farmer down there a little bit more money because they're paying like very little and then turning around and selling it for quite a bit more on the world market. They also, so there's one place, and of course we think that in Argentina, as they get further in towards harvest and what have you, there could be, it's a country that feels like there could be just some maybe labor disruptions this year, and it's an election year, and certainly have had lots of issues. But, you know, you look at Russia, and of course they're not, you know, exporting. You look at the Ukraine, and they have stated that in food wheat, they ask their exporters to only export no more than 1.2 million metric tons between January and June. You know, they did the same thing with sorghum and barley. And so basically it looks like there's issues percolating around the world. And so, you know, they're worried about food. Maybe wheat is a little bit, good quality wheat is a little bit tight. You look at China, same thing. We're finding that there isn't a lot of good quality wheat in China. They may have some wheat, it just isn't good quality wheat. And so, you know, I think underneath all of this, and wheat's had a whale of a break, you know, just since December, 15th or whatever, the week of December 15th, we have broken on KC wheat a little over $7 down to just, $5.30, something like that. And Chicago wheat has dropped from around, I think it got to $6.77, has dropped to today $4.97.5, something like that. It's had a whale of a break, so it's hard to say, sell it now. You know, we're moving into the end of January. Many markets, we're seeing more liquidation on positions and what have you. There's always that old-fashioned, and I sort of feel like in a way we have some old-fashioned markets here, but we're moving into what we would think of like the February break. And so, you know, I think corn has that and beans have that attitude as well. And of course, when wheat can't seem to hang on real well, you also have Great Britain, for the first time in 6 years, is going to be an exporter of wheat, and usually they're an importer. So, you know, we've got some things going on. I think their wheat may be better quality, but France and Kazakhstan, the largest producer in Central Asia, their wheat is poor quality. It's feed wheat quality rather than, so they might back off on corn imports, but as far as food, they don't have it.
Right, and now you mentioned the break that we've seen, and that brings us right to Doug's question. Now, we always like to get questions from our viewers on Twitter and Facebook, and you can find us at Market to Market. So Doug sent us one of these. His question is, should we be looking to re-own sold wheat with calls on this break?
I think that wouldn't be a bad idea, and I commend him for having maybe made some sales, because we're hearing a lot of people didn't, you know, so I would commend him for doing that. And yes, I think now is the time to maybe be looking at down the road on wheat to go ahead and possibly be buying some calls. You know, at the moment, I don't know if I'd put a lot of money into them yet. My weekly timing indicators are still not looking as good as I'd like them to, but underneath the surface, something's percolating in this wheat market. It may take a little more time, but something's percolating. And you know, Mike, the wheat market is usually what leads bull rallies in all grains.
And that leads us right into corn. We're not seeing a bull rally in the corn market. We just seem to be grinding lower. Is that going to continue through February, do you think?
Well, maybe not totally, no. I think we're, again, in the February break behavior. And, you know, corn had a 99-cent rally. We were blessed. And, you know, 99 cents, you're asking a lot if you expect it to keep going at this time of the year. Very traditionally, you know, markets do tend to slack off in January. So I think that we can fall back down. You know, we closed near the lows of the month, and we closed near the lows of the week. So it would not surprise me if next week we came in here and we started to slack off a little bit more again, maybe into the 10th, 11th of February. Maybe it comes a little sooner. A lot of years it's by the 5th or so. And then I think we'll catch and try to start to move up as we move towards the Commodity Classic and the first few days of March. Again, there's another old-fashioned seasonal pattern there. And of course, if that happens, I would really recommend you get some cash sales done because we'll get a chance, I think, down the road as we go towards summer when our planting's all done. You'll get a chance, I think, to buy those calls back to protect those sales. And I think, you know, if you look at harvest out of, well, early corn harvest is already happening in Argentina, but if you look at their main harvest, it'll be more May. Our weather for spring is forecast to be quite nice. So the harvest, or not the harvest, but the planting season should go in easy this year, contrary to what it's been the last couple of years. The attitude will be, well, gee, it's going in easier, therefore maybe an earlier planting hope might just sort of lend itself more negatively. I'm looking for markets to break April into May.
And so that sets us up when we talk new crop corn, and anticipating perhaps that easy planting and maybe that negative mindset in the markets price-wise. Should folks be looking to make some sales after we get through this February break of new crop corn?
I think I would. And you might get another chance on new crop corn maybe into the summer on maybe what could be a weather concern. You know, Iowa is already starting to look dry, Minnesota, South Dakota, part of Nebraska, North Dakota. So there is a little bit of concern out there. You know, even I'm curious to see how Nebraska fares out of this, but basically I would say you might get another chance to swing. A lot of times new crop corn will do that. And let's face it, you know, you look at Dees corn and it's at $4, $4.07 or something like that. And you know, the low on last year's Dees corn was $3.18.5. Now, that's not a very big range for a normal year, a whole year of trade in a new Dees contract of corn. So somewhere in there, there's going to be some rallies because they've got to get room to meander all the way, or how low is low going to be? Or are we going to put those lows in way early? So I think the markets are going to give you something this year. You know, I know there's a lot of gloom and doom, but we also have to remember all the major corn-producing countries are slacking back this year, cutting back, and then if you throw any weather at them at all, we could see a market that changes its complexion. It could happen, and especially as we go into 2016.
All right, well, now let's jump over to the bean market. Is that same outlook as play? I know we're anticipating more acres. Let's talk new crop first. More acres in this next bean crop. Should folks be, what should their plan be if they know they're planting beans?
Well, it's a four-letter word. It's called sell.
Okay.
You know, it's, we've been kind of pushing people over, you know, through the fourth quarter to make some sales. And we still recommend that if you get a chance back, $10 is going to be psychological. The one thing I think we have to think about is, okay, let's look at Brazil. Okay, Brazil's forecast, all of a sudden, you know, we've had AgRural, we've had AgriConsult, and we've now had Safra C. Mercados. All three of those this week have come down in their expectations of production in Brazil. So it's kind of tipping that way, but still not enough. It's still a huge crop if they were to just rest where they're at, but they're now moving down under the USDA. Okay, so you look at Brazil, and they were late planted, 20 to 30 days on average. There's some early pockets where they're harvesting, 4%'s harvested. But, okay, 20 to 30 days later than normal, the gut slot of that harvest or the good start into it probably will be more later February and March and then April. So all of a sudden now, here you are. That's another period where we're also going towards our planting season that is expected to be good weather. To me, that's a lot of bearish psychology. And so I think we're going to have any rally you get here in February, I would recommend taking advantage of it, because you know what? You can turn around and buy calls and protect yourself, again, probably as we get into June, something like that, and have yourself a little bit of protection. You can do short-dated options. In corn, you can do short-dated options if you want to protect yourself. On the downside, maybe look at May short-dated options, but based on the December contract. Basically, I just am kind of negative here as we go into the next quarter. And then I think we have maybe something good through the summer, but then maybe we roll right back over again.
So make some sales, both new and old crop, probably before we get to that gut slot of South American harvest.
Oh, I think I would, because, there's one more thing. If you look at China, and in December, for example, they bought 40% more beans than they did in November. And in the meantime, if you look at years when they've had an aggressive commitment versus their annual ratio to their annual exports, U.S. exports to China, well, a normal average of those type of years would be 44%, or right around there. At the end of December, they were sitting at 80%. So, to not expect some cancellations, we've already seen earlier than normal a few, although ironically, there seems to be some unknown destination ones, which seems to me like one exporter's canceling, but another one's picking a lot of it back up. Regardless, you get Brazil moving into harvest, and it's moving in easy without a wet fall for them, and you're going to have a market that's going to have a lot of pressure on it as we go through March and into April planting season. I just don't think that you're going to want to. But the market's moving fast. I mean, it doesn't feel fast. But you've had, what, a 70-cent break here this month.
We're
going to kind of pace ourselves. Market will give you some rallies, but maybe you need to take advantage of them.
You bet. Well, now let's jump into livestock, talking a little bit of a rally. The fat cattle did move up this week, just about $3.50. Do you think we've posted a low here in the short term?
Yes, I do. And I've been pretty bearish cattle. But I do think we have a potential of a rally here. The March feeder cattle, for example, on that contract, not a continuous year in, year out, but this year's March feeder contract, when it came on the board last year in March, after the other one expired, and to our high in October, November, we've had a 6.18% retracement here this week of that whole move. So we've taken a lot off the table here. And then, of course, unfortunately today, the biennial cattle inventory report was bearish. It showed much more cattle than what we thought we had. In other words, the expansion was more aggressive than what we thought this past year. Beef cows and heifers that had calved, basically 104% or so of 2013. Traders were thinking that number would be 102.7. 500 pounds and over calves, certainly around what, I want to say 102 or something like that, 101, and of 2003. Everything came out at 101 or higher on every category. It was a total surprise, and I think the trade was surprised. Regardless, we might set back a little bit on Monday on that, but I don't know as if it'll be long-lived. I think the market, we had the meat turn, we lost $11.30 on the choice meat this week, and so it's not moving real well, but the bottom line is the cash market seemed to kind of give us a little bit of a lift. You've got cash at 159, but futures are, around what, 155, 156, so they've narrowed that base of spread, so they've done that. I think that you could get cattle to bounce in here this next week. I don't think it's like a V-bottom kind of a thing. Mm-hmm. I think it's a market that moves up, and then it gives you little snapbacks, and then it moves up, and it gives you snapbacks. Almost like a congestive correction here, and then I think you turn around and peak. maybe the 11th of February or something around in February, and you roll right back down. I think we're going down into April. But the bottom line is we have had really healthy corrections, so you've got to be real careful now.
And that's true both fats and feeders.
Yes,
we've
it
seen.
is.
And so both watch for that 11th as the
I think so. And the
high
one
date.
thing I would also say on the April fats, I think it's April fats, I noticed that, you know, my thought was we would go and take out the August lows, which we've done on everything. We've done them on every contract, feeders and fats, but we have not taken out the August lows on a lead contract. So, you know, that would be like when Feb goes off the board, it would be April cattle, that kind of thing. We have not taken out the August lows on a lead contract, and I thought that was kind of interesting.
Yes, it was. Now we have taken out, or we've moved up for the last 2 weeks in the hog market. So, Sue, before we let you go, where do you think this hog market going to continue to trend higher? Well,
I think that there's demand for pork. You know, we've got this West Coast issue with the longshoremen and the strike, and it keeps sounding like it's going to get settled. But we've got to keep one thing in mind while we've got stuff backed up to go out, product to go out, we also will then be taking product in. And the dollar has had a 50% retracement of its last major high down to the lows of, what, 2012-13. We've come 50% back on that. So, you know, that sure is enticing, I think, to these foreign countries to ship things here. And in the meantime, of course, Australia's weather today was talked about how bad it was. I think the hog market might still see some enthusiasm yet, but I think it's a hedge if you get it.
All right. Well, thank you so much, Sue Martin.
Thank you.
That wraps up this edition of Market to Market. But Sue and I will continue our discussion and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts and streaming video of our program exclusively at the Market to Market website. And be sure to join us next week when we'll examine new commodity programs included in the 2014 Farm Bill. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Renewable Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Renewable Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.